Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monty, and this is a one-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. As I do each and every week, I leave my lines on the chart so you can see how the forecast worked out. And last week, I drew this diagonal line right here, with the end of the line being 339.77, which was my price target for the diamonds. Yesterday on the 15th of April, we hit that precisely. Today we went a little bit higher, but notice what kind of candle that is. Let me zoom in there for you. That is a doji. That's a sign of indecision. Those are the types of candles that are usually found at pivot points. And in addition to that, you can see we have a wide divergence from that moving average, almost as wide is what we saw back here at the beginning or mid part of March. And you can see that we pulled back from there to that moving average. In addition to that, look down here, we have 8 green candles in a row right there. That is a stale green light. And for those of you who have been following along with me, you'll know that a stale green light tells us that we're long overdue for a red one. So my forecast for next week is that we're going to pull back just a little bit. I'm not expecting a massive sell-off, but as you can see, we have a slight drop in volume on that doji. We have the stochastics right there crossing with a sell signal. And while we have higher highs coming in over the last couple of weeks, look at what we're seeing here on the CCI, slightly higher highs. That is known as a negative divergence. So that's my forecast. For the diamonds, I would suggest that you continue to trail your stops up, protect any profits that you might have, and make sure the option traders especially are rolling positions to collect the cash. So that's the diamonds. If we take a look at the VIX, another interesting chart here. See, it was still hovering along these lows here. I'll zoom in a little bit more. This is my forecast. This is a 2 to 3 week forecast for the VIX. End of that line is 23.98. I'll even round it up to 24. Look at the patterns here. Long shadows starting to show up. This is very close to a hammer pattern. And while these red candles are showing up, look what's happening to the stochastics. Stochastics is crossed with the buy signal here and is still going higher. So my forecast for the VIX is still in place. I'm not moving that, which means I'm also not moving my S&P forecast on the spiders. I'm just going to move that out. You can see that we're expecting a pullback after this long stretch of green. What happened? We had this little itty-bitty red candle show up, and then we continued back up. Now, why is this candle so important? Well, because if you look at what we saw in the diamonds, we're seeing another doji right at the top. Look back here. See, as I magnify that, similar candle. That's usually what we see at pivot points. Now, the difference here in the spiders is that the volume is still going up. Now, I'm not going to say I'm abandoning this price target down here. I'm not. I'm keeping that in place. But I am going to say that next week, probably early Monday or Tuesday, we're going to go up a little bit more before pulling back. And the main reason for that is because the increase in volume tells us that the buyers are still in force. But ultimately, I'm putting this out just like that. Now notice how I'm drawing this angle. Again, it's pretty long. That's out into mid-May. But the angle that I drew here is similar to the angle here and similar to the angle here. The stochastics are crossing with a sell signal, and we have a negative divergence on that CCI, just like what we saw in the diamonds. So all these things are mixed with most longer term signals are still pointing lower. And I'm not trying to be the wet blanket here in this party, but I want to make sure everyone is focused very much on risk management. I'm going to interject something here that you may not be paying very close attention to, and that is PE ratios. Some of you may have heard of the Shiller PE ratio. Basically, it's a mathematician that takes the average earnings over a 10-year period, and if you put that into the price or the average price of the S&P, look what we have here. It's pretty amazing. Back in 2000, which is at the very beginning of this chart, PE ratios were averaging right around 34 right here. Again, that was right before the crash of 2000. You see that? And then we proceeded to drop 40% over a 3-year period, and that is documented in the history books. Now, in addition to that, what do we see here? PEs of 28. Now remember, the average all-time historic PE ratio is 17.1. Right before the crash of 2008, we had this happen. The PE ratios were reaching 28, and that's 11 points over the historical average. Now, while you think, well, this time in our history is different, we have all kinds of stimulus coming in. Well, that's the problem, actually. We have inflation here boosting prices across the board. We have the printing of money, spending of money, yes, but people are getting caught up in this rally, not paying any attention to this number right here. The PE ratio right now, the Schiller PE ratio is 37.4, which is more than double the all-time historic average for PE ratios. Now, that either means prices are extremely overvalued or companies are earning a lot less as compared to the price. One of the two, or both, are happening, and no one seems to be paying attention to this. Now, why am I even pointing this out to you? Because I want you to pay very close attention to risk management. If you're not paying attention to risk management, then the market could very well catch you by surprise. I came across a video on YouTube that I'm going to share with you in the description box. It's Hyperinflation is Already Here. You just haven't realized it yet. It's one of the best 19 minutes of your time that you'll spend. It really explains the situation that we're in and the potential hazards ahead of us as inflation continues to rear its ugly head. Now, I'm putting that in the description box below, so make sure you watch that, share it over and over and over again, make sure everyone knows about this, and also make sure you're using good risk management strategy here. So my price target for the spiders down here is 395.03. Again, that's a longer term price target. I think we're going to go a little bit higher next week, possibly hitting 419.73, and then watch for the turn lower, and that's the spiders. Now, if we look at the Qs, again, I tend to focus on the monthly chart on this one because it is worth focusing on. Obviously, we don't look at the monthly chart every day, but look what's happening. We have that dramatic drop in volume here. Even though that's a green candle, we still have a couple of weeks left in this trading month. And you see the negative divergences showing up in the CCI. Again, that's giving us some more signs of caution. Watch out below. We get wide divergences here of that moving average. That drop in volume is one of the biggest tells that you can find, because what that is telling us is that the buyers are losing their momentum to push the prices higher. So with that said, I'm going to flip back to the daily chart, keeping this forecast in place, because on Wednesday we had a bearish engulfing pattern followed by, guess what? That's a hanging man followed by a doji. Oscillators are crossing here. The CCI again showing this negative divergence even though we're going to higher highs. Wide divergence from the moving average. We have gaps below the market here. We have another gap down here. And believe it or not, we have 3 successive gaps in a row. So you want to make sure that you're paying attention to those, because gaps generally act as price magnets. And ultimately, they will most likely fill. So make sure you're, again, keeping an eye on the downside, protecting your profits, and making sure that if you're an option trader, you are rolling your positions for cash. Now finally, if we look at the IWM, this is the Russell 2000 ETF. This one continues to push out as a head and shoulders pattern. We barely got over this moving average here, but we have back-to-back hanging man patterns. Look at that. Those are obviously bearish if you're following along with the technical charts. So for the IWM, I'm going to erase all this. I want you to remember that head and shoulders pattern, and I'm going to draw my downward target right there. Why? Because we have a resistance area right here that has been met. And like I said, the oscillators are starting to hinge lower right here. This is not a major pullback, but a pullback possibly to the 20-period moving average, right around 221. That's 220.99 to be exact. And I hope you enjoyed this report. If you had the chance of joining me on the Crypto Boys versus the Oracle webinar. I had that posted on my Twitter page. If you like, you can just like that. Follow me on Twitter. Be one of the 35,000 followers there, and we will give you updates along the way. John and Pete also put out their market reports along the way. 3 of 3 is John, and then Pete and John on CNBC do a great job broadcasting market events and news and such. And of course, if you follow us on Twitter, we will make sure we stay on top of that with the latest updates. I keep it non-political these days. I'm just going market related. And please, if you can, like and share this page, because if you like it, the algorithms are going to pick it up. If you share it, more people are going to have eyes on it, and you're helping everyone in the process. So thank you very much, and we'll talk to you next week. So long.